I think this particular section, this is very relevant for you also, because anybody, an engineer who comes out of your college and then he goes on to set up his own enterprise, he will be immediately confronted with this. The moment you start any, let's say, any business, especially if you're trying to manufacture something, even the smallest thing, even if it's a micro unit, this concept of operating cycle, of working capital management, these are all technical terms, but these are very real. These are things which are very, very real, and which any entrepreneur must have a very good idea about these things. And then the last one is financial statements of banking companies. This is just to give you a little idea about the world of banking and how a bank actually functions, and what are their main sources of liabilities and asset, what are the risks. For me, this is irresistible because I have spent a very long time in this career. So I thought it's good if we have this. So broadly, we have to cover a number of things, and the time at our disposal is a little less. Ideally, this should be spread over at least, in my opinion, it should be at least 60 hours. But in place of 60 hours, we are going to do it in 12 hours. So, it is a little short. So we will try to keep it, keep the class moving, take you from topic to topic. If at any point you feel that you want more reading material, you feel that there are things which you want me to develop in more detail, you let me know, please. Okay, Mr. So that way I'll understand, things better. And let me also wish Jaspreet. So Jaspreet, आपका
yes sir,
गुड इवनिंग आपको. आज हमारे
good evening
साथ
sir.
जी भी हैं, तो ये भी आज ज्वाइन कर रहे हैं हमारे क्लास को. और
Yes sir.
आज से अगले 6 क्लासेस तक ये हमारे साथ रहेंगे. और
Okay.
ये बेसिकली अभी जो हम लोग आज जो करेंगे इसमें, we will be doing this. We will start with corporate strategy, and basically this is the starting point of the course. So I will be speaking today almost entirely Jaspreet in English, so that Ravi Chandran ji is comfortable, and I'm sure you don't have any trouble with this at all.
Thank you.
No,
Thank you,
sir. No issue.
Fine. And we have our Pooja is here also. So welcome, Pooja.
Yes, sir. Good evening.
Good evening. So today we have a new participant with us, Mr. Ravi Chandran. So he is someone who is a principal in an engineering college, and he also wants to understand a little about financial concepts. So from today, we will be making an overview of various things which are part of our course. But from today up till September 2nd, the whole of this month, basically, we will be looking, fast tracking many of these different units. So it will be like a fast, sort of overview for both of you. And for Ravi Chandran ji, it will be an introduction to these different parts of finance, like corporate objective, corporate strategy, financing decisions, all these things. And a little bit of accounts, little bit of financial planning. Number of things are going to be packed. For him, it is going to be an intense period. So let us start with this first part, corporate strategy. Now, when we talk of strategy, one thing I'm sure all of us are clear is we are thinking in terms of a long-term plan. See, a strategy is, if you look at the definition of this, it is a series of goal-directed plans. That means there is an objective. To reach that objective, I need to make a plan. But in the case of a company, it is necessary for me to think in terms of a series of small plans which will gradually take me to my objective. Because it is not, you cannot have just, like it's the path may not be very clear for you. You have started a company, you are entering a new market, there are many challenges before you. So you make a series of small plans which will ultimately take you to your goal. Now, these plans are meant for one purpose. It will align the business's structure, culture, and resources. See, these are the three things which you have. So when we say structure, we mean the legal structure of your business. So normally, when we speak of structure in the world of finance or the world of management, we generally think in terms of let's say the simplest form of business structure will be a sole proprietorship. There is one person who is running the business. Very simple. He the one-man show. He runs the business. He has some employees. So maybe a very small business will go like that. So the structure, legal structure is sole proprietorship. Then you can have a partnership. Many people can get together. They can form a partnership. Third, you can have a company. After partnership, the next form is company. So the legal structure which we are interested in is company. And the big thing about company, what distinguishes it, what differentiates this between company and the other two, partnership and sole proprietorship, is that a company, it is easy to raise capital. Pooja, are you following?
Yes, sir.
Just breathe. It's okay?
Yes, sir. Yes.
So in a company, it is easy to raise capital. See, if you are a sole proprietor, the only capital you have is your own. And maybe you can go to a bank. In the case of a partnership, the different partners can contribute to the capital. It will be more than sole proprietor. But then they can also go to a bank. But beyond that, there is nothing they can do. But in the case of a company, it is possible for me to float shares in the market, go for an IPO. Many thousands, lakhs of people can contribute to my company. And with that fund, I can then have a great business, do some worthwhile activity on a large scale. So the first thing is, we are talking about corporate strategy. Corporate typically means company. Whenever we use the word corporate, we are talking about a company. So the structure here is referring to the legal structure of a company. The significance of the structure is that it allows you to raise capital. You can get a lot of capital, and it is very well, regulated. There is a registrar of companies. If you plan to go for a public issue, you will be dealing with SEBI. There are lots of government regulations. There is a Companies Act under which you will be actually functioning. So there is a lot of expectation from you to maintain transparency in your dealings. Second is the culture. See, every company, every organization has a culture. Some organizations are driven by one man. Even if it is a company, it is very closely held. That person does not allow other people to take any decisions. He takes all the decisions. It is like a dictatorship, autocratic system.
Sir, I have a question.
Yes, just please.
If a company is not that much big, so they can also list their company, or is there any limitation that these companies can list or these not?
No, there is no limitation except that you have to have a few years of experience. You cannot start with listing just. See, you need to first start off, do the business, have a few years of audited balance sheets, show the SEBI that you are a profitable organization with a viable business model. Only then will you get the permission to list. Otherwise, no. You cannot start with simply listing. because it is
We
expected.
should have a brand, or we
Right,
can
brand
just...
is not important.
Okay.
But it should be functional. It
Hmm.
should be functional. It should be something which is buying and selling goods. It should be capable of producing a service or a product, and that service or product is sold, that is generating revenues. And so
If a
ideally what
company...
happens, no, just let me complete this.
Yeah, sure.
Ideally,
Sorry.
it starts with a private company. You start as a private company. You can have, like, you don't need too many people. 5 or 6 people are there. You start it. More than 2 people, you can have a private company. You register with the registrar of companies. And then you are allotted a unique number. You become a company. You are a corporate now. And then you begin to function as a private company. You put your own money into it. At this point, you can borrow money from the banks. But right now, you are not selling shares to anyone. The only shares which you will sell is to private individuals who are willing to invest in your company. Then, after some years of functioning, when you have a track record of success, when you know that you can show, when you go and apply for that listing, you will have to show the balance sheets, the financial statements of the previous 3 years. And you will have to show that you are profitable. Only then will you get permission to approach the public for funds, for shares. Does that answer your question?
Yes, sir. But if I'm not a manufacturer, I'm a reseller, then also
That makes no difference.
I can...
That makes no difference. It makes no, you don't have to manufacture. You can have a company which is entirely, the purpose of that company is simply to make money. How it makes its money? If it makes its money through trading, no problem. You do that. Suppose you want to set up an import-export business. Do it. You have a company, set it up. In fact, if you want to run an educational institution, even then you can have a company. See, the purpose of the company is to make a profit. Ideally, in today's world, when you are going for a company, it is assumed that you are not doing it as a charitable business. The purpose is to make a profit. So the structure of an organization basically refers to its capacity to raise money. In a company, this is the easiest way of getting more funds, because it is possible to get more and more people to put their capital into your venture. Second is the culture. How the company actually takes decisions. Is it a flat process where everybody can contribute, or is it a process where it is top down? There is one person at the top, he is taking all the decisions, everybody just has to obey that. And then there are the resources. We will look at this. When we talk about resources, we are talking about all types of resources. The financial resources, the physical resources, human resources, intellectual resources, everything. So this is what the company has: structure, culture, resources. And the plan which you have, the strategy that you have is, it takes these 3 things and it aligns it with the opportunities. See, you need a business opportunity to do business. So essentially, the company will try to make use of these opportunities, and it will remain conscious of the threats in its environment. Now, the threat can be from many places. Simple threat is whatever raw material you are using. Let's say for some reason that raw material is suddenly not available so easily. So your entire business model is now in trouble. Another threat can be from a very aggressive competitor. They are able to produce what you are producing at a lower price, and you are finding it very hard to exist. These are examples of threat. So you have to operate in this environment. where there are many other companies who are also trying to compete for market share. And your strategy is to find a way through this and make money. This is the concept of a corporate strategy. Now, what typically it will take into account what? The vision and mission of the company. We will discuss this in the next slide. Whatever you are planning to do, like for example, you, Jaspreet said that, do I have to manufacture something? Maybe it is not your mission to manufacture. In the next slide, I'll show you a company, a very large company, huge company, which manufactures nothing. But the moment you see the company's name, you will immediately recall, and you have probably used this company. You can keep guessing for 2 minutes. By that time, I will reach the next slide, and then you will see. Next, the allocation of resources. Whatever resources you have, how are you going to use these resources? In what exactly, how much money will you use? How will you use your staff? How will you use the patents that you have? All those things. What machines will you decide to buy? And then you will have to prioritize. What do you want to do first? See, a company has a vision. It wants to do many things. What exactly do you have in mind? So your strategy will typically, take all these things into consideration. If successful, if your strategy is successful, it will create a competitive advantage. That means in your particular area of operation, you will be able to emerge as someone who has an advantage over the other companies who are operating. There are many competitors. So for example, Ravi Chandranji, your college, I think we've lost Ravi Chandranji. So in that case, Jaspreet, your company is dealing in, what did you tell us last time?
LED.
LED.
Manufacture LED. Yes, LED panels.
You're manufacturing LED panels.
Yeah.
So these LED panels which you are manufacturing, there you must have something, something special which allows you to sell this in the market. Maybe it is the price, maybe it is the quality, something, something about that which other people are not doing as well as you. And because of that, your customers are willing to come and basically buy those LED panels. Or in the case of Ravi Chandranji, let's say he is running an engineering college, there has to be something special which he is contributing. Maybe the students who are coming to him, they are getting jobs. Maybe, their basic fundamental knowledge of engineering, which they pick up in his college, is better than in other colleges. If that is happening, his college will begin to have a competitive advantage. That means students will prefer to come to him rather than go to some other college, because in his field, there are any number of other colleges which are operating and which are going to give him competition. Am I right, Ravi Chandraji?
Yes, sir. Of course, sir.
So, if everything is okay, this will lead to wealth creation and success for the company. This is the basic, let's say, the objective of your strategy. Now, what is a corporation? We just discussed. Is a company registered with the registrar of companies and is generally run by a board of directors acting on behalf of the owners. It is a distinct legal entity. This is a very, very important part of this whole company game. What this means is, whatever assets are in the name of the company, in case the company tomorrow goes into liquidation, in case the company has to be wound up, and whoever it had borrowed money from, those people have to be returned that money by selling the assets of the company, you cannot touch the personal assets of the directors. you can only touch the assets which belong to the company. You see, this is the protection which every director or entrepreneur who is investing in this company, that is the protection that they have from being personally accountable for failure. Are you getting my point? Ravichandran ji, did you get this point?
Yes, sir.
Yes.
Jasprit, you have understood
Yes,
this? See,
Yes,
a
sir.
company, let's say that 5 people form a company. They are all, let's say, very rich people. They all contribute 1 crore rupees. 5 crores becomes the paid up capital of the company. That is the capital in the hands of the company. And then let us say they go to a bank and they are able to take a loan of another 5 crores. So they have 10 crores. With 10 crores, they start a business. They register themselves. They begin, let's say it is a trading business, they buy and sell goods. And so with this capital, they begin to buy and they begin to sell. Somewhere down the line, what happens is when they sell on credit. उधार में बेच देते हैं. तो जब ये उधार में बेचते हैं, तो कई बार क्या होता है कि लोग पैसे वापस नहीं करते. They sell on credit and these debtors of theirs, they do not return the money. Gradually what happens is that they are selling goods, they are selling on credit and they are not getting paid. Let me tell you, this happens in a number of cases. And then what happens is they find that it is not possible for them to manage anymore. Now the bank will immediately begin to send notices. The bank will want to take whatever legal action it can to take back its money. See, the bank has given 5 crores. Company is not running. Let's say the company is now in trouble. Its sales have become 0. It is not running at all. Now, in this particular case, the bank will take action against the company. The bank maybe will go to the National Company Law Tribunal and they will say, let us get this company liquidated. Sell the company's assets and give us back our money. Let's say that the assets of the company, which the bank is able to sell, comes to 2 crores. It will take those 2 crores. It still needs 3 crores. It cannot do anything with the personal assets of the directors. Those rich people who had come and who had, put their money there, maybe they have much more than 3 crores with them. But the bank cannot touch them. Because that is the meaning of having a company. That is why the liability of each person is limited to the shares which he has bought in the company. So if there were 5 people and each had bought 20% of the shares, whatever his liability is limited to that. You see that word there, limited. Whenever you see a company at the end of so you will have Reliance India Limited. Okay. All private companies also at the end of it, those 3 letters are there, LTD dot limited. This is the meaning of limited. So when I say corporation, I am by definition talking about a legal structure which protects the directors and share of the company from any personal accountability in case of failure. And a large number of companies fail. If it fails, those people who had financial dealings with the company, they will take a loss because the company will never have enough assets to pay back its creditors. This is the meaning of corporation, and this is the meaning that it is a distinct legal entity. See, you, me, all of us are all legal entities. The company is just like us. It is a legal person. First point to remember. Now, take a new company. Company starts. First thing it does is, it has to have a vision. And I'm talking about a good company, a company which is interested in doing some serious business. The first thing it will do is, it will basically have a vision, number one. Now, what is the vision? The vision is where the company wants to see itself in the future. It is like a statement of intent. This is what the company wants to do in the future, and it is stated in one line. Give an example. The company will also have a mission. Now, this is the purpose for which they were created and would include details of what it does. Once again, I'll give you an example. The vision and mission tell us about what the company wants to do, what its broad goals are. The board of the company takes action to fulfill these goals. So you are setting yourself a goal. You're setting yourself a goal. This is why you have created your company. This is what you plan to do, because you are taking money from, let's say, initially the different shareholders who come to you, and later on from the public. So there has to be absolute clarity. Why do you want money from us? What will you do with this money? First. Now, second, look at this. This is Amazon. Remember, Jaspreet, you were saying, does it have to manufacture something? Here is one of the biggest companies in the world. It manufactures nothing. And what is their vision? Our vision is to be the Earth's most customer-centric company, to build a place where people can discover anything they might want to buy online. See, this is what Amazon, when Jeff Bezos created this was the vision which he had in mind. I want to create a company which is entirely focused on customers, and to build a place. See, this market which he is building is basically an e-commerce website, something which does not have a physical entity. It only exists on our laptops and phones and in the servers which the company has. And what does he want to do? He wants this place to be a place where people can find anything they want and buy it. And most of us who have used that, is there anyone among the three of you who has not used Amazon? I think sometime for something or the other, you would have used Amazon.
Yes, sir.
As far as Jaspreet and Pooja are concerned, it is,
Yes, sir.
there's no contest.
Almost
Ravi Chandran ji, I'm sure you have definitely used
Thanks.
Amazon. Okay.
Of course.
And what is its mission? To serve consumers through online and physical stores and focus on selection, price, convenience. Now, it is for us, all of us, as customers, as persons who use Amazon, to say whether they have achieved this or not. Now, if they have achieved this to some extent, we will keep going back to Amazon. And as we keep going back to Amazon, they will continue to succeed. This is the meaning of vision and mission. Now, the strategy which they will make is going to be centered around this. This is the goalpost is clear. This is the goalpost. This is where I want to reach. So the strategy that I make, in the last slide, I told you, these are a series of goal-directed plans. So these are my goals right here. To reach here, I will have to achieve some other goals also, smaller goals, subsets. And these subsets will, as you achieve these smaller goals, you will ultimately reach the big goal. The big goal is here, to make sure that any customer can buy whatever he wants on your website. A smaller goal here could be to build up the number of sellers who are available on your website. Because the more sellers there are on your website, the more range of goods will be available for selection. See, and here it speaks of selection. The more sellers there are selling the same type of good, the more competition there will be. And that will lead to discounts. And we are all aware of the discounts which are available online. And of course, since you are doing it from the comfort of your home, it will lead to convenience. So this is the goalpost. Once you have this goalpost, you can now think about, now I'm not talking about Amazon specifically, but now you understand why vision and mission are important for strategy. Because if I don't have a goal, how can I make a strategy? To make a strategy, the first thing is that I need to have a goal. That goal must be very clear. So the corporate strategy of the company answers the fundamental question. How do we use the resources of the company to achieve its goals as set out in the vision and mission statements? This is the basic purpose of your strategy, and this is what the strategy should be able to do. And how do we use the resources to create a competitive advantage for the company? Competitive advantage will be coming back. Remember this word. You understand a bit, you will understand it more. Now, strategy, basically, it will take into account three factors. Resources of the company, number one. Now, when we say resources, like I said, we are not only talking about money. We are talking about everything. Physical resources, human resources, the financial resources, intellectual resources, all those resources are coming in. Capabilities and competencies. You have resources. Now, what do you do with those resources? At that point, you will need to have some skill sets, something special, which will allow you to use these resources to do a business. And then, whatever you have, if you have these two, you have to take these two and take advantage of the opportunities that the company has. Now, you have a certain number of resources, a certain amount of resources, certain types of resources. Given these resources, what opportunities are available for you? What can you do with these resources? See, if there is no opportunity, then you can have all the resources in the world. It will not make any difference. So there has to be a market somewhere. Somewhere, people have to be interested in buying what you are selling. See, the basis of capitalism is that all of us are traders. All of us are traders. Sab vyapari hain. Everyone is selling something. Now, for a trader to be successful, somebody has to buy it. And if there are enough people ready to buy something, you will have your opportunity. Okay? And while you are doing this, yes? Did anyone have a question? Yes, Jaspreet, you have a question?
No, sir, nothing.
Oh, fine. And while you are looking at this side, your strategy also has to consider the risk that the company faces. See, the biggest risk that you will face will be the financial risk. Because when you use these resources, using the resources means consuming something. You are consuming money to do something. You will be paying salaries to these staff members who have the capability and competency. You will be paying for the raw material that you buy. You will pay for the advertisements that you put out. You will pay for all the actual overhead expenditures which the company has. So there is a risk. If you fail, this money is gone. So your strategy has to be smart enough to take care of these things. Once the strategy has been made, the company can proceed to the planning stage. Then you go for the small parts of the strategy.
Sir, what is the meaning of competency?
We'll get to this. We will, the next slide. No? See, competency is the ability to do something. That specific ability that you have to do something. Jaise, you can think of it, if you speak in Hindi, so you will say chamta. You need to have that ability to use the resources to do something with it. See, it is not enough to just have the capability. The capability will become a competency when you can actually use whatever resources are available with the company to do something productive with those resources. That is the basic point here. Now, so when you begin to use these resources, you will have to create something which is a little better than your competitors in the market. Assuming that there is an opportunity and people want to buy this product that you are making. But remember, you are one of the producers of this product. If you are producing mobile phones, there are 20 other companies also producing mobile phones. So basically what happens is that when you produce it, there has to be something special about your phone which will attract the customer. Maybe it is the design, it could be the price, it could be the the technology in it. It could be the service network that is there. If something happens to the mobile, there are people in the market who can fix it up. All sorts of advantages can be there. But there has to be something. And that something, whatever that X factor, call it an X factor, whatever it is, it will give you a certain advantage over your competition. Whoever are the other people who are competing for the same customers. Now, competitors try to sell their goods and service to the same customers. This point you need to remember. So it is not you alone who is selling. So the advantage that a company has depends on these things: the resources, the capabilities, and the competencies. Maybe you have staff who do things better than the other, your competition. Maybe they are more customer friendly. Maybe they can come up with better ideas to connect with the customer. Something special has to be there. What are the resources are the assets of the business. Remember this. This is not the accounting asset. Here we are using this in a more general layman's way. These are the things which will help you to build up your business. So first is the physical resources. Second is the intellectual resources. Third is the human resources. And then you have the financial resources. You can take it in any order. Doesn't matter. See, physical resources can be, in the case of companies, which you think of a mining company. A company which is mining the land, let us say for iron ore. So it has a license to mine. Physical resource. You have a license to produce something special. That is a physical resource. Intellectual resource. You have the ability to come out with a formula to produce, let's say, a special drug, a special compound, which can be made into a medicine and you sell it. So that is an intellectual resource. So you can use that research and development. Think in terms of a company which makes medicines, a pharmaceutical company. What is the biggest resource that they have? It is their R&D team, the research and development team that they have. That those intellectual resources are the basis for their success. Today, when we fall sick, we need to go to a company which has a good brand, which has the medicine which I need. How did they get this medicine? So they got this medicine because of their intellectual resources. Then the human resources. If there is intellect, there has to be human. So the human resources are, one part of it is getting merged with this part. Then I need other people. Now I need accountants. I need marketing people. I need quality control people. I need finance people. All these people are together, they become my human resources. And then I need money, financial resources. Now the capabilities are the ability to exploit these assets. These are my assets, all these. The capability is, can I do something with this? Can I use all these things to produce something, either a physical commodity or a service, any service. Can I do something with this to produce something which somebody wants to buy? This is the capability that I'm talking about. Maybe I can do something with these assets, but nobody wants to buy that. Because the purpose here is to have something which can be sold. If it cannot be sold, then you are not in business. See, the basic thing is a business begins, and this is not, I'm quoting a very, let's say, heavyweight management thinker, Peter Drucker, where he says that a business begins with a customer. You can have all the resources that you want, but if you don't have a customer, nothing is going anywhere. You are going to be right where you are. Number two, the resources have to be used in a way that best serves the firm's goals. This depends on the way these resources are deployed. And who will do this? This is the leadership's role. See, we talked about human resources. One big resource is this. There needs to be someone who will give these directions, who will take you through this whole thing. The physical resources should be used to make the best product. Financial resources should be used judiciously. That means it has to be used in a way in which they are not wasted. Money is not kept idle. Let's say you borrow from the bank, and for 2 months, you have borrowed a few crores of rupees. It is lying in your account. You are paying interest. And for 2 months, you are unable to use this money. You cannot take the decision what to do with this money. Why can't you take the decision? You are unable to select the people from whom you have to buy raw material. So that money will lie idle. And idle money is always a cost for you. Why? Because you are paying interest on that money. So financial resources have to be used judiciously. Intellectual property should be safeguarded and used for the benefit of the company. Intellectual property, like we were talking about the pharmaceutical company, which has this different formulas for chemical compounds which can be sold as medicines. You have to get these patented. You have to ensure that nobody else makes this. This is why there is a very strong law against trying to copy somebody else's work or trying to do something which the rights for which are with someone else. Why is America today one of the countries which has so much money, which is so powerful? It is basically because of this IP. See, the actual physical production of let's say a phone, let's say an Apple phone, is done in China, is done in Taiwan, physical production. But the biggest chunk of the profit is in America because they have the intellectual property. Without that, the technology which goes into an iPhone, nobody can produce it. Coca-Cola formula, very famous. That unique formula which Coca-Cola has for the taste which a Coke gives you. When you drink a Coke, there's a particular taste that is based on something unique which the Coca-Cola company has. That is their intellectual property. That particular combination of different materials which will bring this taste. Human resources have to be deployed so as to get the best out of the personnel. You have the right man at the right place. Now, competencies, Pooja, your question, are a cross-functional integration and coordination of capabilities. Cross-functional means there are different functions in the company. Next page, we will be coming to that. There are different functions. The ability for all these functions to work together towards one goal, whatever strategy the company has, the competency is that. Can I get all these people are capable? Each of them are capable in their own particular fields. Can I do something which will take all these people, make them work in a team, make them work towards a common goal, and then achieve what the company wants them to do. That is your competency. That will come from leadership. That will come from your ability to work as a team. Jaspreet, in your company, like when you go there and you work, I'm sure that there are many exercises in team building.
Yes, sir.
Where you know your team better, you understand what all of you should be working for the same thing. You cannot have a situation where you are trying to do something, your teammate is trying to do something else, then nobody gains. In that case, you will be considered incompetent. See, it is very simple. Competency means that the whole team works together towards a common goal. Now, like we said, cross-functional integration and coordination of capabilities. What are the functional areas? Operations and manufacturing. This is Ravi Chandranji's area, engineering, this part. Marketing and sales. Quality control, finance. I can think of many more, but let's just go with these. These are some of the basics: finance, operations, marketing. And in the manufacturing part, quality control, I'm also including. Let's say these are the major functional areas of the business. Now, these different departments have to work together as a team. And when they work together as a team, the company will begin to be better than its competitors. It will be able to make use of the opportunities that it has. Now, let's take some examples. Let us take the case of Apple. Same, we'll take the 4 functions. Now, operations and manufacturing. Innovative products. See, this is the advantage. Innovative products, excellently designed, that consumers desire and are willing to pay extra for. You try to buy an Apple phone, mobile phone, you will find that it costs more than other phones. Still, you want to buy it. Their market share in India, which is not a rich country, is still increasing. Everybody wants to buy because it attracts, because of the design, because of the functionality. Now, look at the other part. The company owns chip manufacturers. There are chips inside your phone. The company owns these, controls manufacturing, follows extremely strict software standards, and operates its own stores. So basically, this is the quality control. They are ensuring that every single part which goes into that iPhone conforms to the standards which they have set. When they designed the phone, they had a particular design in mind, a particular standard which they wanted to maintain. And they make sure that whoever helps them to manufacture, like we know that most of the manufacturing is done not in America, but in places outside America. Generally, Taiwan, China, these are the places where these things are done. But those people have to work as per the standards set by Apple. And considering the standard of these phones, how good they are definitely meeting those particular standards. Now, it also has a community of more than 6 million independent software developers creating applications for Apple products. So when you buy a phone, I think more than my generation, Pooja and Jaspreet, you are more interested in the apps which you can download. Because if you have a certain range of apps, they will make your life easier. You can access different things, whether it's finance, whether it's entertainment, whether it's games, whether it's physical fitness, anything at all, you need an app because the app takes you to the appropriate place and it helps you. And it is designed for use in a mobile. So even a person like me who is a senior citizen, today I begin my day with an app. For me, let's say it's a news reading app. So I start there. So these apps have to be designed. And Apple has a community of 6 million independent software developers who are doing it for them. So that basically means that more and more apps are there, which a person who buys this Apple phone can use. So it becomes an incentive to buy an iPhone. And this is what the operations and quality is all about. Design, conceive, design, make sure it's manufactured as per your standards. And then, since this is a phone, make sure that sufficient software apps are available to be used on that phone. Marketing and sales. It has an ecosystem of suppliers, developers, and business partners, which provides Apple with a strong competitive advantage. For example, if you want to buy an Apple phone, apart from their own stores, you will find that in India at least, we see unicorn stores. So it is, when you look at the store, you will immediately think of Apple. Everything is white. That is the way the store is designed. It has a signature of its own. And they help to sell these Apple phones. They give you discounts. They have all the latest products. They give you a service facility. And finance, it is a debt-free company. No debt at all. So this is how, their strategy, this is how it works. Excellent design, innovation, something which was not done before. Make sure that you make something which customers really want and are willing to pay extra for. And you're there in business. And then you just make sure that they are manufactured as per your quality. Then you get other people to help you. And after some time, you're making so much money that you don't need any debt at all. Okay. Take another one. This is a homegrown company. This time we're taking, Maruti. Same phone. Quality of cars in terms of design, fuel efficiency, durability, etc., and price. See, Maruti, apart from giving you a good driving experience or giving you a decent car, is also about price. Out of 15 top models in terms of sales, all India basis, Maruti had 10 models, numbers 1 to 10, in 2019. This figure will be slightly different today, but it gives you an idea about the public acceptability of Maruti. Quality control, good technology. How did they ensure this? Through a tie-up with Suzuki. Japanese car maker, they tied up with them. They got the technology. Marketing and sales, wide network of dealers, excellent service network, backed by very low maintenance costs. I don't know whether any of you have ever tried to get a Maruti repaired in one of their service stations. I have. I can tell you this, that the cost of any repair work done is very, very low. And the quality of work done is excellent. And the range of the service stations that they have all over the country is huge. All these things are helping with their sales. Because when the customer comes, first he is attracted to the car, then he looks at the price, and then he begins to look at these additional features. If the car has a problem tomorrow, how will I get this car serviced? He is interested in that part also. And then finance, once again, debt-free. In an industry which is capital intensive. That means to make a car company, you require a huge amount of capital. But over the years, Maruti has made so much money that they have been able to pay back all their creditors. And they are now debt-free. So these are examples of strategy, corporate strategy, which are very successful. So obviously, I'm taking two very successful companies from two parts of the world. One with a very large world market. The whole world is its market. And the other with a market which is mostly in India, but which is Maruti also exports to other countries. So to some extent, this is also a company with an international market. Do you people now have an idea about this? Are you clear about strategy? Any questions, anything?
Yes, sir. Clear.
Yes, sir.
Yes.
Okay. Now let's look at some more components. Product, market, scope. So you're making a product. It has to have a market. Which products will the company manufacture and in which market will it sell these products? The market segment, in terms, see, market is segmented. That means the market is partitioned into in terms of age. There are many things which younger people prefer to buy. There are some things which people maybe of my age are more interested in. So if I'm making something, I should be aware of how many people are going to buy this. Income. Some products are meant for a particular income group. In fact, each product has a particular income group in mind. See, a luxury car maker is not interested in people with low incomes. A car maker like Maruti, which is making entry-level cars, also making entry-level cars, is more interested in people who want a car and have low income. They want to give those people a chance. So it all depends. Existing players who the company will compete with and the products that they offer will have to be considered. So when you want to make a product and you know there is a market, you should also note that there are many competitors. There are other people making the same product, selling to the same consumers. So you'll have to keep this in mind when you design your product, when you think of your price, all those things. Now, competitive advantage. This can arise from technology. Maybe you have something special. In the case of both Apple and Maruti, the two examples we gave, technology was a big driver of their success. Apple, I think, almost entirely technology. Maruti also, when it first came in the 80s, considering that at that time the competition was the ambassador cars and Fiat cars, when Maruti came, the technology was a huge, huge advantage that it had. Fuel efficiency was much better. The driving experience was better. Nobody in India had seen, at least people with less income, middle-class people, had never seen a car like this. Then it could be design, it could be human resources, marketing, selling capabilities. Something has to be there. Then there are distinctive competencies. All good companies have a core competency, something that they do better than other companies. If you don't have this, now you will not become very successful. You will exist, you will make some money, but you will not be special. And if you are not special, you are not going to make a very big success out of your business. And then there has to be synergy. Synergy is basically between the core competency of the company and the product market scope. Everything has to be aligned together. Whatever competencies you have, whatever resources you have, that they have to work together so that they begin to capture the market. So that they first begin to produce something which is attractive, which is desirable, and which sells. And when all these four things come, your strategy basically will be a success. And these are the things which the strategy has to ensure. Okay? This is an example of product market scope of let's say I'm thinking of a small company. What are the resources that this company has? Look at this box first, this blue box. It has an IP, a patent for a new washing powder that is more eco-friendly. This is the basic thing which it has. It has the funds to buy the machines needed for this. Capability, the company has qualified staff who can make the washing powder at the desired price. Now, who will buy these products? It could be individuals, it could be industrial laundries. Now, basically, what will be the procedure here? They will manufacture the detergents. The marketing team will make sure we'll build up a value proposition. We'll get to this. Value proposition means what is so special about your detergent powder? What is that extra value that your detergent powder has, which will make it desirable in the eyes of a customer? This, if the marketing team can show this, if they can convince customers that this detergent powder is actually very good, it's good for the environment, it's good for washing your clothes also. So if you do this, let's say my marketing pitch is that since it is eco-friendly, when you do this, you are helping the environment. So I not only get a detergent powder, I feel good about myself. I have done something good. I have managed to, let's say, take harmful chemicals and not put them in my drainage, in the wastewater, because I'm using something which is eco-friendly. So my sales begin to increase. Now, based on the feedback that I get from my customers, I improve the product. So I have an R&D team here, which has to take feedback from sales. The sales team will do well if the marketing team can build up the brand properly. And the marketing team can only build it up if the product manufactured lives up to the promise, which has a certain level of quality. If it has that, marketing, it's easy for them. If they can build up that value proposition, that feeling in the eyes of customers that, yes, this is a good product, this leads to more sales, which when the sales happen and we begin to get customer opinions, then I can feed this to my R&D team who make the product even better. And the new versions of that detergent now, they consider this, these changes with the R&D team is bringing. And the marketing team will similarly pick up these new features, further build up the brand, and sales will increase further. So all these different departments, the operations, the marketing, the R&D, they all have to work together. And that is the synergy. See, when they all begin to work together, they create something extra. And that extra which they create, that is what ultimately gives the competitive advantage to the company. In this particular case, the competitive advantage is built around what? It is built around the eco-friendly nature of the washing powder without any loss of cleaning capacity. And the price is also reasonable. So I'm managing to give you a good product at a reasonable price, but with one additional feature. And that feature is that this particular product is not harmful to the environment. And this, because we are more conscious about the environment these days, we are likely to buy this product. So you have so many, let's say, cleaning liquids being sold today under the brand green. These are green. Green basically means these are eco-friendly. And I think whenever we go to buy these things, it has a certain impact on our decision making. We think, yes, if we can buy something which will help the environment, it's a good thing. So it gives that company a little advantage over the other companies who may be selling the same product, but which is not eco-friendly. Okay. You see these fridges, a fridge or a AC, which have those star ratings. And it says if it is a 5-star fridge or it has a 5-star rating, it will basically be using less electricity. So if it uses less electricity, you gain because your electricity bill is less, but at the same time, you also help to reduce the consumption of electricity. And in that way, you contribute to the environment. And they charge more. See, when I bring the environment into the picture, I make my customer feel good enough to pay me a little extra. it becomes an advantage for me. Am I making sense here? Are you getting
Yes, sir.
this?
Of course.
Yes, sir.
Okay. So next, let us look at our next part, diversification and value creation. I've put some of these, little posters out here, Tata, Reliance, Adani. As we go ahead with this, later you will remember this slide and you'll see why I put it up. Right now, small question mark in your mind. Where is all this coming? Okay. Now, diversification, when we speak of this, simple meaning is to increase the variety of anything. That old term we have, don't put all your eggs in one basket. If the basket falls, all the eggs will break. You will be the loser. Now, this particular slide I had made in the context of a personal portfolio of financial products that you may have. So all of us will be making some investments. Ravi Chandranji is older than you too. So he has made some investments and I'm sure he has many financial assets. Maybe he doesn't call it a financial asset in his mind, but he knows that he may have a share, he may have a unit in a mutual fund, bond, debenture. Any of these things, these are financial assets. What is the basic thing in a financial asset? There is a commitment by someone. Let's say the company which issued the share, the mutual fund company which gave you the units of the mutual fund, they are making a commitment to you to return your money to you with something extra. When you buy the share, you are trusting that company. See, the big thing in a financial asset is that when you buy it, you are making an investment for something which you will receive in the future. When I buy a mobile phone, the transaction comes to an end the moment the phone is in my hand. I give the money, I get the phone. But in the case of a financial asset, there is a time period on the way. I'm talking about an investment. So when I buy a financial asset like a share or a mutual fund, I am trusting the commitment made by the person who issued that particular security. And all these different examples, share, unit of a mutual fund, bond, debenture, these are all securities. They are referred to as securities because these are secured by the commitment made by the issuer of the. Is this point clear? The word security and the fact that it is secured by a financial commitment. Just try to link it in your mind to that. So, whenever you buy these things, you are investing in a financial asset. These financial assets are known as securities. Why is it known as a security? Because it is backed by a secure financial contract, that commitment. You go to a bank, make an FD. That FD is a financial asset. There's a contract between you and the bank. What is the bank saying? As per the terms of the FD, we will return this money to you on this given date with so much interest. Financial contract, commitment made by the bank. That is why it is called a security. Okay. Now, mutual fund, same thing. There is a financial contract backed by the law of the land. It is therefore a secure contract. If the bank or the mutual fund company fails to honor its commitment, you will get the support of the law in getting your money back. So all these are securities. Now the same principle applies to shares, bonds, debentures, or any financial instrument. Now, before understanding diversification, let's talk a little about risk. Risk is what? Basically, it is uncertainty. If I put, and here we are talking about financial risk. If you invest, if you buy a share, there is a risk that you may not make as much money as you thought you would, because a share depends on the performance of the company. When you buy a mutual fund, once again, your expectation and what you actually get, there may be a difference. There is a risk that you may not get what you expected. If the company you bought the share in collapses, you will get back nothing. So there is a risk. We don't know about the future. So risk in finance is the chance of a monetary loss. First thing. Every investment that you make, it involves a risk. The mutual fund company, it may not perform well. The mutual fund company may collapse. The share that you bought in any company, if that company may not pay dividends, you can't do anything about it. The prices of the share may fall, in which case you may not get back. Even if you sell in the market, you will get less than you actually invested. There is a risk. And there are two types of risks in investing. The first is referred to as a systematic risk. For all of you, this is just the background. Please understand, I am only telling you this not to give you lots of other words to think about, but just to understand that in finance, risk is a big threat, financial risk. And when we say diversification, it is a way of reducing this risk. This is why I am talking about risk out here. So systematic risk arises from the uncertainty in the economy as a whole. This is also known as a market risk. The whole economy is not doing well. When you invest share of a company, you are expecting the company to perform well and hope to sell the shares at a profit. If there is uncertainty in the economy, then no matter which company you invest in, you will face uncertainty. What sort of problem, crisis can there be in the economy? Suppose, think of COVID, think of a war, think of recession. It doesn't matter whether you invested in Reliance, whether you invested in, let's say, a very small little company called JMD. It doesn't matter. All of them are in trouble, because for a company to sell its products, there has to be a market. And if everybody is in a lockdown, everybody is sick, then only some companies may be selling masks and sanitizers, and some hospitals which are doing business. Every other company is basically in trouble. So that is a systematic risk. The whole market is in trouble. You cannot diversify against this. There is a problem here. Unsystematic risk. This arises from the unique uncertainty of a particular investment. The whole market is not in trouble. Your company, the company which you invested in, is in trouble. Example, you invested in Tata Motors. Their workers go on a strike. Tata Motors doesn't do well. The share price falls. Risk is there. Now, this unsystematic risk, see, why is it unsystematic? It does not affect the whole market system. It is only affecting this one company. It's not affecting Reliance. It's not affecting Larsen and Toubro. It's not affecting the drug companies. It's only affecting Tata. This risk you can guard against. And that process of guarding against it will be through diversification. Now, examples of systematic risk. The government increases the rate of income tax for companies, known as corporate tax. All companies in the country will face higher tax, and as a result, their profit after tax will be less, which means you will get less. If you are getting dividends from these companies, if the government takes away part of those profits, you're going to get less. Inflation rate goes up. All companies will be affected. They may have to pay more to their employees. The price of their goods may also go up and reduce sales. All companies. See, these are systematic risks. There is a lockdown in the country due to COVID. All companies are affected. Systematic risk. Unsystematic, workers of one company X go on strike. Production of company X will suffer. All other companies are okay. R&D scientist resigns from a pharma company. Remember, pharmaceutical companies, they are heavily dependent on their main star scientists. It is the star scientists who do the research, who ensure that new compounds are discovered, which can be made medicines and sold tomorrow. Let's say a cure for some particular disease is made. For that, you need a scientist. Now, this fellow resigns. They are not able to get someone of equal caliber. This company is going to be in trouble. Future sales of pharma company will suffer because new medicines will not be invented. That particular company is going to suffer. Government increases the custom duty on the raw material used by the company. Okay? Company will face higher costs because the raw material costs will increase. Recently, the government has increased the duties on a large number of parts which are imported for China for mobile phones. And all companies which are making these mobile phones and which are importing these parts from China, their costs will go up. Now, once their costs go up, these companies for the moment will either have to absorb the loss or to increase their selling price. If they increase the selling price, they are immediately in competition with other companies, some of them who may not be having this problem, because they are sourcing their material from some other place or they are producing abroad. For example, if in India, an Indian mobile phone company has a problem because the government has increased the, let's say, the import duty on some of the components which they are importing, Apple is not affected. Samsung is not affected because for them, they are doing the producing outside, or they have more sources. They have other sources to get that chip from. They are big enough. So this is unsystematic risk. Now, diversification is what? It is a way of reducing risk by spreading your investment across a large number of financial assets, these securities. So if one company does badly, the other companies which you have invested in, they continue to do well. That is the concept. So to reduce the risk, the investor can invest in many different securities. If one company does not perform well, no problem. I will basically make money from the other company. If I invest in Tata Motors and 10 other companies, Asian Paints, Relaxo, Dr. Lal Path Labs, Pidilite, all are big companies, all are in different industries. This is in paints, this is in chappals, this is in the job of pathology. Pidilite is in basically adhesives. So each of these, their opportunities are different. Their customers are different. If I invest in all of them, my advantage is that if one of these companies doesn't do well, or if two of these companies don't do well, maybe the other 8 companies will do well. And I will at least not go into a loss because of one company alone. Suppose you invest in mutual funds. Never make the mistake of putting all your money in one mutual fund. Choose many mutual funds of a similar type. Put your money in each. It is like backing a horse in a race. One of those horses is going to do well. Some will not do well. In any selection, if you look at it after 1 or 2 years, you will find that some of the funds have performed, some have not performed. Your best hope is that those who perform earned you enough money to bear the loss of those which did not perform. And this is the concept of diversification. So by spreading my investment across many companies, I am reducing my risk. Spreading investment across many financial securities is known as diversification. And when this same concept, this is in the case of a personal investor But when the same concept is done by a company, it becomes a diversification at the corporate level, which we will look at now. Systematic risk cannot be diversified, remember. You can only help yourself with this diversification strategy in the case of unsystematic risk, which affects some companies but leaves others unaffected. Basic thing to remember. This is the concept here. Now, we are now taking the case of a single product company. This company has only one product. So every company sells one or more products. For example, a company may sell detergents for washing clothes. This is the only product that it produces and sells. Now, this is the strategy of the company. Let us focus only on one product. It allows the company to specialize in this product. It can conduct research on different types of detergents. It can show its consumers that it makes the best detergent. Can you think of a company, very famous company, which is doing this? It only does one type. Ravi Chandran ji, you might be thinking in terms of shaving and Gillette. So Gillette focuses on this one thing only shaving products. It does not go anywhere else because it is taking a huge risk. Single product company, it is not diversifying at all. It is focusing on building up a brand based on its huge knowledge about this one area. And over the years, I have seen it all my life, this company has managed to keep growing bigger and bigger because of the specialization that it has built up in this particular field. They have given us a whole, new range of razors. When I was small, first when I was beginning to shave, you had razor blades, which we used to use. And then we began this concept of, disposable razors where twin blades were there. Much safer, better shave, but a little more expensive. And then we came to those razors which had 4 blades. 3 blades first, then 4 blades. And getting better and better. But the price kept rising. But because we were all hooked to this brand, we began to buy them. So this was a risk. Most companies will not survive this one. What is the risk here? If another company manages to reduce the price of its detergents, here we are talking about a detergent company, or come up with a better product or a better deal to its distributors. That means the marketing is for that company's goods will be better. It will lose market share. The competition is doing better than you. You only have one product. Competition beats you at your game. Your sales will come down. So how can the company reduce risk? Strategy is go for diversification. So it can reduce the price of its detergent. Let's forget about diversification. Without diversification, what can it do? It can reduce the price. It can offer a better deal. It can conduct a marketing campaign to show that its product is equally good. These strategies may work, but in each case, the company will reduce its overall profit. See, in each of these, if you reduce the price, you reduce your profit. If you give a bigger percentage to your distributor, once again, you reduce your profit. If you conduct a marketing campaign, once again, your expenses go up, less profit, unless there is a huge increase in customers. Now, another option is to enter into a joint venture with a foreign detergent company. You get some new technology, produce a better detergent. You are still relying on one product only. You are trying to do whatever you can to protect your share because you only have one product. Now, if you take this route, it may help you. But what will this mean? That foreign company is now going to get a share in your profits, because now you will become a joint venture. The moment they give you technology, they will demand shares in your company. And the moment that happens, all future profits, part of it is going to go to your joint venture partner, the foreign company. So basically, you are protecting yourself, but now you have to share your profits. So in each case, there is a problem for you if you are based on only one product. So if I now think of diversification as a corporate strategy, my team thinks that, okay, how can I do something about this? Corporate strategy, they come out with diversification. Let us have more products. Let us not just rely on this one product. So here...
Sir, I have a question.
Yes, Pooja, tell me.
Sir, joint venture means partnering with foreign companies like something.
Or an Indian company, it doesn't matter. But you are basically partnering with another company for a particular thing which they can offer you. Most of the big joint ventures are generally for technology.
Okay, sir.
Because that technology is the one thing which you cannot get now.
Okay.
Okay, so now there are two ways of diversification. You can diversify within your own industry. If you are making detergents, you try to make a whole range of other products. Or you can diversify by going into another industry. Where the customers are going to be different, the products are going to be different, the needs are going to be different. That can only be done by very big companies. We'll get to that. Now, here, so the company can put in place a plan to produce another product that they can sell to a different group of customers. That is like this. Suppose this detergent company is having trouble with one product, so it decides to make toilet cleaners also. And it decides to make dishwashing liquid also. It will have to make an investment in plant and machinery. Its overhead costs will increase. But the company can jointly market all its products. See, it already has a marketing team. What it can do is, it can now use that marketing team not just to market the detergent, but also to market the other two items which they are now producing. The dishwashing liquid, the toilet cleaner. So they will have to invest more, but they have the advantage that their brand is known, and they will basically try to convince customers that you are satisfied with my detergents. We are now coming out with something. Trust us, we will give you a good toilet cleaner. We will give you a good dishwashing liquid also. You can think of so many companies. If you just think a little, you will see that there are many, many companies which began with one particular thing. You take Borosil. Borosil originally used to come out only with glassware. Very well-designed glassware which we could use in microwaves. And that was their main area. Today, Borosil is getting into home appliances. They are making many, many things which are very different from those glassware which they used to make before. Because they must have found that if I focus only on this, we are basically at risk. So what I do is I begin to produce other products. And when I produce other products, I basically try to attract a different type of customer, a different group of customer, not type, sorry, a different group of customers. And because I already have a brand, at least in glassware, I try to convince them that I did such a good job with glassware. I will do an equally good job with these new home appliances that I am making. Please buy these also. So basically, you are trying to diversify by using your brand. You had a single product, you built up a brand. Based on what you had, that brand which you had, you might now try to convince your customers that, look, we are good for that brand. We will be good for, we are good for that product. We will be good for these products also. What this will do is it will reduce your risk. And if you are successful, your company will grow, your sales will increase, and your brand will be stronger. Because now, within your brand, it is not just detergents that they will know you for. They will also know that you make these other two products. So your brand image is going to improve, the size of your business is going to improve, and your risk has gone down. Please note this. Because you are now dealing with 3 products instead of 1, your risk has also gone down. Because if some other company or competitor comes out with a better detergent than you, the toilet cleaner and dishwasher will continue to sell. There's no problem with that. But your detergent sales may go down. Now you can use the profits from the other 2 products and try to channel those profits into R&D to create a better detergent. In that way, your risk is going down. Are you seeing this?
Yes, sir.
Yes, of course.
Yes, sir.
So this is known as a diversification strategy. Now, let us look at those companies which have gone for diversification in a big way. And they have done it not within their own industry, but they have gone across many industries. Let's take some big names here. Tata Group. Look at the strategy here. Automobiles, they began with steel. Today, probably automobiles is known much better. Airlines, Air India recently. Chemicals, Tata Chemicals. Defense, FMCG, fast-moving consumer goods. Finance, home appliances, hospitals, IT, retail, e-commerce, and more industries. Now, see, the idea is these are different groups of customers. Each industry has a different set of players, a different set of rules involved, different raw materials. Everything is different. Different seasons. So when I diversify like this, and if I'm able to do it successfully, I am able to grow my company while at the same time reducing risk. What do I lose? I lose a bit of specialization. But even there, if each of these companies as a unit works well, it will do well in its own field while contributing to the group. Take Reliance. Same strategy. Oil, petrochemicals, textiles, natural resources, banking, and telecommunications. They have created a whole pool, from which they are taking money. Pool of different industries. And once again, they are reducing their risk by not relying on one particular thing. Larsen and Toubro. We know it mostly for engineering and construction, but it's also into manufacturing. It has technology, information technology, and financial services. See, another company which began with construction and engineering and then diversified into these areas. Here, they began with steel and then moved into many, many other things because they had the resources already. Reliance, same thing. Maybe textiles initially and then so many other things. Bajaj Automobiles. Once upon a time, scooters, 3-wheelers. Today, finance, electrical home appliances, so many other things. Electrical home appliances, most of us will have seen at least some electrical appliances made by the Bajaj Group. It could be a mixie, it could be a toaster, it could be an oven, it could be any of these things. So many appliances made by them. This is classic diversification. Aditya Birla. branded apparel, fashion, textiles, cement, carbon black, metals, chemicals, telecom, financial services. This group does one more thing. It sets up outside the country as well. It operates in Malaysia, Indonesia, addressing those markets, working with different human resources, so that the human resources itself is getting diversified. Now, think of it like this: business level diversification, corporate level diversification. Now, business level is, I am diversifying in the same industry. That example which we had. Company presently introduces a new product. So, like this. Detergent powder for, company presently sells detergent powders for manual washing. Now it is creating a new product, introducing a new product in the same space. Detergent, liquid detergent for washing machines. Detergent, powder, detergent, liquid for washing machines. I was doing it for manual. I'm doing it now for washing machines. It's a slightly different toothpaste. It used to make toothpaste. I decide to introduce toothbrushes. Slight diversification here. I used to make cars. I make SUVs now. I'm introducing one more thing into my range. So here, I am not going outside my industry. Basically, I am staying within my industry. This is a business level thing. Customers are more or less the same. Not exactly the same, but broadly, we are looking at the same customer segment. The same class of people will be buying all these things. Now, you make a new range of products for a different market. The two products may not be connected in any way. What we were seeing with the big examples which we took. Presently selling, begins to sell. So right now they're selling cars. They now go for chemicals. We saw this with Tata's, automobiles, chemicals. You're making locks and safes. You begin making kitchen utensils. No connection between these industries. And these businesses are unrelated. The customers for these products are different. There is no relation between them. These companies, the ones which we saw before, Tata, Larsen & Toubro, Reliance, Aditya Birla, they are known as conglomerates. Okay. So basically, what happens here is that when we diversify, we create value. Value simply means that my company becomes wealthier. And where does this value reflect? This value will reflect in the demand for my shares in the market. So as I begin to expand, as I begin to diversify, as I begin to build an image for myself, what happens is my customer base expands, my revenues increase, my profit increases, and in the process, I become a stronger brand. As I become a stronger brand, my market share also increases. And as these things happen, I begin to increase my wealth. First, through the profits that I get. Second, through positive public perception. And this positive public perception which comes, this leads to a demand for my shares, an increase in the share prices. And in the process, I begin to become a more valuable company. So we say that this company is a $1 billion company. This is a $10 billion company. What is that basically? That is based on its sales across industries. All the big ones, except for some, you will find that they are all conglomerates. They are spread across industries. And why do all these big guys do this? They do this because they know that we cannot continue to remain big if we rely only on one industry. We have to basically diversify to reduce our risk. And when they reduce risk, if they do it successfully, they are able at the same time to increase their value. And what can be better? I'm reducing risk, I'm increasing value, and I'm a successful company. So essentially, the whole concept of corporate strategy, one example of corporate strategy is this. I go for diversification, and see, when I said that it is a series of goal-directed actions. So, for example, when this company decides to go here, this is a small goal here. Small goal, make detergent powder. Another small goal, make liquid detergent. Now, to achieve this goal, it will have to think of getting the appropriate human resources to do it. It will have to think of getting the appropriate technology to do it. Those are, again, small goals which they will have to achieve. And if they achieve all those small goals, ultimately, the big goal will be achieved. They will be producing this new product. And when they do that, and when they begin to build up a market share for this product, the ultimate big goal of diversifying, that is done. So this is one example of corporate strategy. You can have the same corporate strategy working for a company which says that, no, I don't want to de-risk myself through diversification. What I want to do is, I want to become a real specialist only in this one product that I have. I don't want to do anything else. So there are, in the field of, let's say, pharma companies, they focus only on their particular area. Jewelry companies, they focus on their area. There are companies who sell diamonds. They sell only diamonds. There's a South African company called De Beers, very famous for making diamonds, supplying the world. They don't need to diversify. They have huge physical resources, those places from which they can mine diamonds. They have the technology to extract those diamonds. They have the technology to market those diamonds. They focus on one area. So their entire strategy is build up our strength within this area, build up more and more market share, build up our brand as the place to go to for this particular resource. In this case, example is diamonds. And in the process, I create value. Value, wealth, basically. So there are many ways to create value. You can do it through diversification. You can do it through specialization in a single product. But ultimately, whatever you do will be part of some strategy that you will form. That is what strategy is all about. And if you keep going back to what we said earlier, that strategy is going to depend on the resources that you have, the capabilities and competencies that you have, and the way you make use of the opportunities available in the market, while at the same time being very conscious of the risks that are there. So some companies, they felt that the best way to handle risk was to diversify. Other companies felt that the best way to handle risk is to specialize, is to go for intensive R&D, is to build up a name in that same one product area. So there are different ways, different strategies. Single product strategy, that is one. Having a diversification strategy, that is another. Investing in R&D, that is a third way. So these are different ways of achieving the same goal of value creation. And this is what I mean when I say diversification and value creation. Diversification can lead to a reduction in risk and bring about value creation. But please remember, you can have that value creation even without the diversification, provided your strategy is good. Provided your strategy, the way you have made your goals, that is true. If that is okay, you will do well. So this is the basic thing here. Any questions on this? I know
No,
I'm
sir.
going. It's okay.
Yes, sir.
Actually, I'm going a little fast, but I hope you're keeping up with me here, and I'm not losing anything because of a slightly faster pace. Normally, I might have liked to slow this down and give you more examples, but I'm not sacrificing anything as far as the content is concerned. I'm just speeding up the delivery part. So if at all there is anything here, see what you can do is read a little about, take any of those companies which I have given there. Take the Tata Group, for example. Just read about how they expanded. Read about the challenges they faced. You'll find all this material on your phone. Just begin to read a little more about these things. You will begin to see what strategies they had. The word strategy may not be there, but you will see it. Like behind their actions, behind the decisions that they took, you will see that strategy which they had. When they built the Nano, what was the strategy? Strategy was build the cheapest car, get into the entry-level car market. If we can get there, it will be a big fillip to Tata Motors. Now, something went wrong with that strategy, it failed, led to loss. So they were unable to see many things. Next strategy in that space was let us go for electric vehicles. Talking specifically about Tata. So they came out with Nexon electric. And they found that this was successful because the government was giving subsidies for this. The government was also giving you tax rebates for this, because it was felt that electric vehicles contribute to the environment. So today, Tata Motors are the leaders in the sale of electric vehicles. After Nexon, they came out with Tigor. Tigor is also an electric car. So this was the strategy. Let us look for, so their idea was, okay, we failed with Nano, no problem. Let us have a huge range of vehicles, come out with many, many different cars, Zest, Bold, Tigor, Tiago, Nexon, all these came after the Nano shock. And many of these cars began to sell well. Give it a good service network, strengthen the service network, strengthen the technology, build up the driving experience, and let's hope that we can sell. That was the strategy. At the same time, let us also go into a business level diversification, go for electric vehicles. Build up the competency to go for electric vehicles. Electric vehicles today are something which the future, it's futuristic. It is something which we will see more of in the future. Gradually, infrastructure for charging those vehicles is being built up. So as these infrastructure networks get built up, if I have cars there and somebody else is building up, the government and other private players are building up the supporting infrastructure, I will gain. More people will buy my cars because they will feel that yes, there is a service available for these cars. The charging facilities are there. So it's possible for me to take this car and go on a intercity journey, because it will be possible for me to charge these cars. Today you have portable chargers. So you see, as you begin to think like that, you begin to open up different possibilities for your company. You want a cleaner environment, so electric vehicles are important. Here is an opportunity. I have the resources. I already have a production process. I have a company which is capable of making cars. Why don't I take this company, make use of this opportunity? There is a risk, as there always is a risk. But right now, given my resources, capabilities, competencies, I think I can do it. They believed in that, put that strategy in motion. The result is today they are the market leader in that particular segment. So With this, I come to the end of my session on strategy. So the next thing which we will take up in the next time we meet, we'll have a session on these business models, which is much less complex than this. And then we'll move on to corporate objectives and then begin to discuss different things about, see, in business models, we look at the old business models, which are basically physical in nature. So you had to have a shop, or you had to have a factory, and we think of the new business models, like a digital business model, like an e-commerce company, or a franchisee business model. There are many, many ways of selling things. So we look at the different ways there are of doing this, particularly the new business models which have emerged after technology has made this possible. We'll do that part, then move on to corporate objectives. Is profit the only corporate objective? Are we looking for long-term gain? Are we actually thinking of making more wealth? If we do this, how much do we have to keep investing in our company? Is it at the cost of dividends which we give? There are many things which I will bring to your attention, which you can think about. So that's all for today. We're reaching the end of time, also 8:30. I hope all of you enjoyed that. And if not enjoyed, at least you were able to sit through it. Thank you for that. And Ravi Chandranji, how did you like the class today?
So it is wonderful, sir. So you have given a lot of information in a short period of time.
Thank you so much. So I'll keep trying to, stimulate your mind with these little bits and pieces of information every lecture. And think about these things, do a bit, if you can find time in your schedule, do a bit of reading about this. Sure, it will help you. Okay. Yes, and Pooja and Jaspreet, I hope you have followed.
Yes, sir.
You would have noticed that the whole, what shall I say, the tone of today's lecture was different from what we were doing earlier.
Yes, sir.
Mainly because before we were looking at some very basic concepts. Now we are looking at something which is bigger. The scope is bigger. Okay then. Thank you. And see you next Saturday. Okay. Bye then.
Sir.